In today's video, I will make you very clear about what are the difference between a mutual fund, index fund, and ETF. Hello everyone, welcome to my rich journey. Firstly, let's start from the mutual fund. The reason why I start from this one is because of history. The first mutual fund issued in the United States can trace back to the year 1924. The mutual fund is a company that pools money from many investors, and they will invest money in the securities such as the stocks, bonds, and short-term debts. The combined holding of the mutual fund are known as the portfolio, and investors buy shares in mutual fund. The most common mutual funds are, firstly, fixed income fund, that is to invest money in bonds or other fixed income instruments, and understanding to typically carry less risk than stocks and equity. The second one is the equity funds that invest the stock market to help investors to grow over time. And third one is the multi-asset funds, are designed to deliver returns by investing across asset classes and dynamically adjust investments over time. The biggest feature of the mutual fund is the professional portfolio manager will help you to make the investment decisions, which is to say it's a kind of active management. Of course, because of the professional will help you to make choice of the stocks, the corresponding commission is high. Usually it goes to 1 to 3%. In other words, if you have $20,000 in your account and you are trading at a 1% commission fee and you need to give $200 to the fund manager. But if you lose your investment and in your account is only left $15,000, but you still need to pay $150 in commission for the fund manager.
Oh my God.
The second feature of the mutual fund is the trading time. Unlike stocks, which can be sold at any time during the regular market hours, mutual fund is traded only once per day after the market close. You can enter an order to buy or sell mutual fund shares at any time, but your trade won't be executed until the closing of the current trading session or the next trading session if you place your order after hours. The price of the mutual fund is calculated after market closes, so most mutual funds aren't really designed to be trading vehicles, but rather are meant to be held as a long-term investment. Next, let's talk about index fund. Some investors believe finding the right stock is to predict future. It's hard and it's a kind of gambling, just like looking for the needles in the ocean. So the best way is to buy the ocean, where the index fund come to the world. The index fund was created in the year 1976 by John Bogle, the chairman of Vanguard in the United States. The index fund tracks the performance of the market index to generate average market returns. For example, the S&P 500 index, the Nasdaq 100 index. It follows the performance of the specific basket of underlying investments, so it's very simple and no need to find a professional portfolio manager to look after. Thereby, the commission fee is very low, which goes to 0.05% or less. It's a kind of passive management. Index fund is a type of the mutual fund, which is quite simple, provides investors with average market returns. And mutual fund, on the other hand, are not always index fund. They can be used by professional managers to actively select a portfolio of stock or bonds. Since the index fund is a kind of mutual fund, it also can be traded only once per day after the market close. It's not ideally for the one who wants to track ups and downs in the market and cannot be able to buy and sell at any time during the regular market hours. Now comes to the ETF, shorted for exchange trade funds. ETF generally track and aim to outperform a benchmark index, like mutual fund and index fund. ETF invest in a basket of securities such as stocks, bonds, or other asset classes. However, it can be traded whenever the market is open, just like stocks, rather than once per day after the market close.
Nice.
The first ETF was launched in Canada in the year 1990. In the United States, the first ETF was listed in the year 1993. The ETF is very popular all over the world because it offers the investors access to a wide range of markets around the world, usually at a low cost. Most ETFs are passive investment, meaning the commission fee is very low and sometimes it's free. Besides, ETFs suitable for investors who do not willing to invest that much. For example, VTSAX is a popular index fund in the United States, and the minimum amount you must invest is $3,000. And you cannot buy the index fund if you don't have $3,000. Instead, you can buy the VTSAX ETF, which is to buy a small ratio of shares, let's say $200. Well, this is the difference between the mutual fund, index fund, and ETF. As to me, I would like to suggest making a long-term investment as predict the future is too hard to most of people. Buying the mutual fund, index fund, ETF is trying to diversify the risk, which is very good. Finally, there is also a thing that I need to remind if you want to invest in United States stock market. If you are not a United States taxpayer, as a foreigner, you cannot directly invest in the United States index itself. Instead, you can buy an ETF index fund. If you are interested in how foreigners can invest in the United States stock market, please leave me a comment and I will share you how in my future videos. Well, this is the thing I want to share today. Please subscribe my channel and I promise I will continually produce useful information. Thank you for your time to watching my video. This is my rich journey and I will see you in my next video.